What's up, traders? Welcome back to the Chanel channel. I'm your host, Mark Stalker D, and today we're diving into something that's gonna blow your mind harder than finding out you got stopped out by a tick before a massive reversal. Don't you hate it when that happens? We're talking about day trading with options levels, not trading options, but just using options to find your way in the maze of price action intraday. I'm talking about looking at where the market wants to go by looking at market maker positioning. Now, I've been trading since 2007, and yes,
I'm that old.
I can tell you that most traders are leaving money on the table by ignoring how prices move from and to these levels. Hold up. Before we continue with today's video, I need to have a quick intervention with you. Are you still clicking buttons like you're playing whack-a-mole? Do you make trading decisions based on the sophisticated technical analysis of, oh, I think it's gonna go up? Well, I've got some news for you. What if I told you there's a way to stop trading like a coked up hamster and start developing the kind of deep situational awareness that makes other traders think you're psychic? I'd like to invite you to check out the Market Stalkers method. And no, we don't actually stalk the markets in a
creepy way.
Right? We're more like market detectives with really good data. This is the only CPD certified trading course created by yours truly, a Series 3 qualified trader with 18 years of experience. That's like 126 dog years. Here's what we teach you. How to read market structure systematically. Order flow analysis that makes price action reading crystal clear. How to apply profile sentiment and statistics around day types. Finally, quantitative extremes that play out at a very specific time of day, nearly every day. So instead of clicking buttons as if you're diffusing a bomb or something, you'll start using actual data and price developments happening right in front of your face. And here's the kicker. Right now, we're running a 70% off the bronze tier for August. After August, this deal will disappear faster than your account balance on an FOMC day. So don't sleep on it. Don't sleep on it. The link is in the description below. All right, that's my shameless self-promotion for the day. Now, where were we? Oh yeah. You know how everyone talks about following the smart money? Well, guess what? The smart money leaves breadcrumbs in the options market, and they're practically screaming at us. Oi! Oi! Here we are! If someone puts comments now, FVGs, I'm just gonna go and jump off a bridge. Any single prints or big moves are only a mere result of the prices hitting the open interest levels from the options chain. This is the case these days that has especially been amplified in the post-COVID era. So if you could have a way to find out where these prices are to look for true reactions, isn't that better than crawling along the 1 minute chart or 30-second chart looking for any old gap the price may have left behind? Just an idea, you know. Okay, let's dive in. We're looking at high open interest levels from the options chain. Open interest is basically a fancy way of saying how many contracts are actually sitting at particular prices. When you see massive open interest at certain strike prices, it's like seeing a traffic jam on the motorway. The market generally doesn't just blow through these levels like they're made of tissue paper. These levels can act like magnets. The market gets pulled toward them, but they can also act like a brick wall that stops the price dead in its tracks. And if we're talking about options, we have to mention implied volatility. But here's how I use it. Implied volatility tells us how much the market expects the price to move on a particular day or in a particular period. Think of it like a rubber band. When the implied volatility is high, the rubber band is stretched tight. The price, whenever it moves, it has a lot of room to snap around like crazy. But if that rubber band is loose, the moves are generally going to be more controlled, and even on some slower days, they're gonna move as much as your grandma after a Christmas dinner. And when you know these two implied volatility levels, you can actually calculate how much space you have before the market kind of goes, nah, I think I'm done for the day, and either completely fizzles out or even makes a U-turn if it happens early enough in the day. So let's say the implied volatility suggests that we have enough space to move 55 points to the upside from current prices. And if you're up 45, 50 points by noon, maybe, just maybe, it's time to start looking for the reversal setup rather than buying any sort of a perceived breakout like a noob. Now, here comes I suppose we could refer to it as the industry secret that most retail traders don't even know exists. Like, we all know about big strike prices, where most calls and most puts are located. Those are obvious, right? And despite how you feel about market makers, because most of you think of them as some big bad bearded man who's like going after your stop losses on your sim account, they don't actually care. All they care is about maintaining something called the delta neutral state. And they try to do that to the best of their ability. So we have the big calls and puts, right? But then we have these other prices that have a little less open interest. They're actually called gamma exposure levels. Specifically, I want to see where GEX 2, 3, and GEX 1 are located. Back in the day, I used to stare at the option chain and the matrices until my eyes bled. But these days we actually have a company called Mentor Q. They created an awesome indicator that plots these levels as a simple line on the chart, making it much easier to visualize the price behavior around these levels as we approach them. If you click below this video on more or show more, depending on which device you're using, you will find the link and a little discount code that you can use upon signing up. We also have to talk about, let's call it a day type, but in the options that's referred to as the gamma environment. Think of this concept as the market's mood ring. When you hear that we have a negative gamma territory, the price becomes more volatile than a toddler who missed nap time. It starts throwing temper tantrums, they're screaming all over the place, all the moves are amplified. And the reason why this happens is the market maker activity. As the moves get more volatile, they actually have to start buying more or selling more, which amplifies the moves. Under those conditions, price can indeed slice through some of those GEX levels that I mentioned. Specifically, GEX 1 is very much prone to acting as an accelerator in negative gamma, especially if it's like sort of somewhere in the middle of the range. But when we have positive gamma, that's the exact opposite, and it's kind of frequently the case on normal days for equities such as NQ, ES, YM. You have these other two levels called GEX 2 and 3. GEX 2 and 3 become stabilizers typically. In absence of any kind of an external catalyst, these levels are more likely to put a stop to any kind of a perceivable move that's happening at the moment. So they're selling into strength and buying into weakness, creating these beautiful tradable ranges that can act as signposts for us mere mortals. So how do we put all of this together without turning into a caffeinated squirrel jumping between like 17 different indicators? 1, we check if we're in positive or negative gamma environment. 2, check your really high open interest levels. Typically they would be where calls and puts are concentrated. 3, look at implied volatility. This tells you how far you expect to travel. And 4, check your GEX levels. They tell you whether you're driving a sports car or a school bus. Now let me give you a real example. I'm just pulling up a chart from today. So I didn't even have to look far. I just had a look what happened today. And this is what we have. Massive call open interest at the 6,500 level on the ES futures. Implied volatility is suggesting we have a 55 points of space before we hit the potential exhaustion area. And we're currently sitting at 64.91. So we're in a positive gamma, meaning that moves are likely to be more smooth and more controlled. We have GEX 3 sitting at 64.75. Now, if we look at what happened, it's exactly what we expect, right? GEX 2 and 3 act as stabilizers. We're in a positive gamma today, meaning moves are more likely to be smooth and controlled, unless Trump wakes up and starts talking. That's a different problem. GEX 3 is sitting at 64.75. So if we look at what happened at the open, this is exactly where the price started turning around. And when the market first opened, we had the overnight low not too far away, and then it did the classic take out the overnight low, then reverse. We used to call this behavior between the two sessions stop, run, and reverse. But I hear kids now are calling it liquidity sweeps or some other fancy name. But the most relevant takeaway here is that this event happened right at GEX3, a known stabilizer level for a positive gamma environment. Okay? Now remember, nothing is a single price. Everything is a slight zone, so you might see the market slightly overshoot before it reclaims the level. That's what you're looking for. And let's analyze this further. So we are still in an uptrend, and the next logical stopping point might be the gamma wall at 6,500 statistically. But we expected at least a slowdown around this GX4 at 6,490. And, look how clumsy the price became. They tried to hold above it, but ultimately they gave us a bit of a pullback. So now what? But we could go back to GEX3. At the time of creating this video, I don't know, I can have a look at it later. But the implied volatility today tells us that we do actually have a room to move all the way up to 65.30. And because today we're in a lower volatility environment, you don't have to rush and you don't have to behave as if your hair's on fire to try and get into a trade. This is like having insider information, except it's completely legal and available to anyone curious enough to know where and when to look. Trading doesn't have to be as hard as explaining TikTok to your grandparents. I know that this seems like it's a very advanced concept, but really once you get the grips with it, it's quite a simplistic concept. The options market is literally broadcasting its intentions every single day. You just need to kind of tune into the right frequency. And these Mentor Q levels do exactly that. I prefer Mentor Q over some of the other similar companies because they also offer a lot of options levels for my products. I'm a commodities and energies trader. I don't really trade much of ES and NQ, but I am well familiar with it because it was one of the first products that I laid my eyes on when I became a prop trader back in 2013. Long time ago. Many moons ago. Let's summarize. High open interest levels shows you the areas that matter. Implied volatility shows you the potential range for the entire day. Gamma environment shows you how the market will behave, and the GEX levels are your roadblocks. That's a wrap for today. If this helped you understand the options levels better than your last relationship, smash that like button on the way out. Drop a comment below if you have any questions or if anything is unclear. I always answer sensible questions. Sensible being the operative word. In the meantime, check out some of my other videos that you might find useful. And let's all try to be less Muppet and more Market Stalker with every passing day. Goodbye.